Hey, good evening. Thank you everybody for coming today, both virtually and in person here to this Audit Committee meeting. Start with apologies, although it looks like a full contingent. Yep, so no apologies. Minutes of the previous meeting. Has any member got any points to raise with regards to the minutes? Doesn't look like it. So can we have a quick show of hands to approve the minutes? Thank you very much. Any declarations of interest tonight? No, no one's showing. Or Shahid.
Director of a housing company. I'm not sure whether I'm supposed to declare that, but that's what I am, so I thought it's better, safer to do it.
Okay, thank you very much. Good. Public question time? No, no public questions. Member question time? No. Okay, good. So item number 40. So Borough Council update audit planning report. So Helen, is this you?
It is. Thank you, Chairman, and good evening to everybody in the chamber. So it's a very short report this time, and so I guess from this one we may segue into the next item on the agenda. It's really to confirm that having completed all of our audit planning, which was largely complete at the time we reported to the last committee, apart from value for money. So it's bringing together the final parts of that. In terms of value for money, sticking with that, we have completed the initial risk assessment against the 3 reporting criteria which are set out on page 16 of the agenda pack. So that's financial sustainability, governance and improving economy, efficiency and effectiveness. We have not identified any significant risks in relation to the Council's proper arrangements. So it means that we don't need to undertake any specific work in any particular area. And so what happens next is that it's sort of the commentary that will be provided as part of the Auditors' annual report will be something that will come to the committee in due course. So once we've completed the audit. The other points that are included on that page, we just wanted to reference auditing accounting estimates because there has been a change in the auditing standard around this, which has increased the amount of work that we need to do, particularly on actuarial models. We included some of that detail in our audit planning report, and it will be something that we will report back as part of our audit results report. And in terms of progress to date, the audit is in progress. We expect to report to the committee at your meeting in February, and I believe that's the next item on the agenda, so I'll stop there. Happy to take any comments if there are any on that brief update.
Members, unless Ian, yes, go ahead.
One question really. It talks about accounting estimates, items that are usually subject to accounting estimates. Would that include, for example, investment and other properties, or what would it include?
Thank you, Councillor. So in terms of the most prominent estimates that are included are around property, plant and equipment valuations. So that's operational land and buildings and investment properties, as you correctly point out. The other significant area is in relation to the IAS 19 pension liability reported in the financial statements. There are also other estimates within the statements, but not all of those will be subject to the same level of complexity and judgment.
Okay, thank you. Yeah, I guess we can move on straight on to the next agenda item, because as you say, it's very much related, and bring in Bob as well to give an update on the statement of accounts.
Thank you, Chairman. I think Bob obviously will want to comment as well. From our perspective, in terms of getting the audit completed for this committee, it was always going to be a challenge, given that we signed off the 2019-20 audit in August. The areas of work are all well underway, and we are working closely with Bob, with Mark and his team in terms of moving that forward as quickly as possible. But referencing back to the previous question, those areas of estimation uncertainty are the ones that always cause the challenges. So there is work across all areas of the audit to complete, but particularly the work in relation to valuation of property, plant and equipment investment properties, and the IAS 19 liability is going to continue through December and into January. Bob, I'll pause there and then let you comment.
Thank you, Helen. And I think just reinforce it. There has been a bit of a perfect storm of events conspiring against us. Obviously, we are still dealing with some of the work around the COVID pandemic and the accounting for that, and the numerous amount of government returns that we have to submit for that, which is all done by the single team. We had hoped, due to the planned start of the audit being around about September time, to commence budget setting earlier. We did commence it earlier, but it has run on into the period. And again, it's around the single team that's doing that. The delay in getting the previous accounts signed off has meant that we are late starting the accounts. So really, we're in a point where we have put as much time and effort and resource in as we can put at getting the accounts done, and the same thing with Helen and her team. So we've agreed an audit approach, but it became apparent quite clear that we would never make this committee eventually as a deadline to produce the final audited accounts. It's worth pointing out that 91% of local authorities haven't made the deadline for signing their accounts. So we're not unique, and there is a number of councils that are still waiting to sign off 1920. And I'd hesitate to say some are still struggling with 1819. So whereas we're not where we'd like to be, we're certainly not in the worst position for local authorities within the country. And having worked with Helen, spoken with Helen today, we feel we have a plan to make sure we will target the February Audit Committee meeting with a completed signed set of accounts. And that's certainly our target and ambition, with a following wind and a clear run at it from Mark and his team.
Hey, if I might just start with a quick question first, because I think, and maybe this is the way that you phrased the last sentence, but I think in the past, this committee's had a chance to review a preliminary set of accounts before they go on and get signed off. So I'm assuming that's your intention again for this year.
It is certainly, and we do have, I believe Mark will confirm, we do have a draft set of accounts published on our website, which was published by the end of September. So there is a draft set of accounts up there, and as we update them and work with Helen and her team, we will reissue another set of accounts. And certainly by the time we get to the February committee, we would hope to be able to give all the committee members an early sighting of the accounts that we're prepared to take into them. So by mid-January, and this is, I don't want to be held to a promise on this one, but we'll have something we can share with the committee that may be updated and changed slightly on the night, depending what comes out of the final parts of the audit. But we can then obviously update committee on what's changed between that and the set of accounts. We'll have issued them as soon as we can with the papers.
Yeah, if I may just add, Chairman, to that, I think it probably was the way that was that Bob phrased it, but the accounts need to come to this committee for approval in February, because obviously you haven't gone through that process, and you will receive an audit results report alongside that to help inform that decision. So we are working towards that. I'm feeling a little hesitant, and I'm grateful that Bob said doesn't want to be held to anything about mid-January, because obviously the Christmas break takes different forms for different people. So some people go a few weeks, but a little bit in advance of the Christmas, and some people take a bit longer off afterwards. And I don't like saying this because it sounds like an excuse. We are all, both council and audit team, absolutely dependent on nobody getting sick at any stage, whether that's with COVID, whether it's with the new variant, or with just the stinking winter colds that are going around. So there are a number of variables in that, but I am sure that although Bob sadly is not going to be around from in January, that I'll be working with Bob's replacement as an interim replacement to make sure we keep you up to date.
Okay, thank you very much. Just one more question from me before I hand over to other members. I wondered if you give a brief update on where both EY and WBC are on valuations work, because I know that's been a subject of conversation in this committee in previous years.
Shall I start, Bob? Is that probably?
Yes, I think so, yeah.
So in terms of valuations work, I think we are better progressed at this time of the audit. So obviously not this time of the year, but at this stage of the audit, we are better progressed than we were last year. We've had a number of conversations between ourselves and your valuations team. The sample's been selected and all of the information has been provided back from your valuers to either my audit team where we're doing the work or onto EY Real Estate where they are looking at a certain number of assets. In part, my nervousness about committing to a particular date in mid-January is down to the level of pressure within the EY Real Estate team, which continues to be very real and very present. And we tip over into January and then they start getting shouted at by my corporate colleagues who are doing audits at that stage. So part of the discussion I had with Bob and Mark this afternoon was waiting for this committee this evening, actually, and a meeting that we have with Graham Ebers tomorrow to then sort of say, actually, my council is getting very upset about this, and therefore, to put the pressure on a little bit. So if you wish to say to me, please, can we make sure it happens, then feel free, because I can pass that on.
Yep, you can certainly pass on that message. take that as given.
Thank you.
Members, have you got any other questions? Maria, go ahead.
I think you've answered most of my questions about valuation. So it's really the pensions and the valuation of property and other assets that's holding things up.
I wouldn't say that they are holding things up, Councillor G, on the basis that the audit really only got going in October. So okay. There is a lot of work to complete.
Okay, right, thank you. And one thing, I did have a look at the accounts. The last version is the one on the 30th of July. And Bob, you mentioned September, or it might have been Helen that mentioned September. There's no further update from the one that was published on the 30th of July then?
No, that would be the version they had there. We had to have it published, available for inspection, I think, in September, which is why that's the one we had up there. Obviously, that allows people to inspect it and ask any questions of either the council or the auditors, but it won't be the final audited version which we bring in to the February accounts. Okay. In the version of the accounts that's up there, it says, please note that adjustments still need to be made during August 2021 for revaluation of council dwellings and approximately 60 other assets. Adjustments are also needed for disposal of assets held for sale, including sale of residential properties related to Elmsfield redevelopment and one HRA property. So it says those adjustments need to be made during August 2021. So could you tell us the nature of those adjustments and how much they are, whether they're reducing income, whether there are loss or profit realised or unrealised? I can't to hand tonight. If it helps, I will get a report across to people saying which properties are in that list there and what the valuations come out as. I mean, at the time, the valuations work was still being done by our valuations team, and it has been further verified by an external property valuation expert team as well. So we have that confirmation around our valuations, but the actual details I can't provide tonight, but I can get a report to you, or my team will get a report to you.
Okay, that's great. And just to clarify, I have got another question on this later. If there are realised losses, does that get taken against income available for services?
It depends on the nature of the loss. If it's a downward valuation, then it would be written through the I&E into a revaluation reserve. So we have a revaluation reserve that is where we first charge any revaluation losses to. Impairments will be taken directly straight into the council's I&E account. So potentially, yes, they will be, but it's again taken as the larger picture of the whole asset portfolio.
Right, so revaluation increases or sales at a profit are well, sales at profit must be taken to income and expenditure. Revaluations upwards are taken to the revaluation reserve.
They are, yes.
Yeah, and but revaluations downward or sales at a loss go to the income and expenditure account first and then to the revaluation
No, the
reserve?
revaluation reserve would be brought down to a point where then, if it goes below its original holding value, we then charge that to the I&E account. I believe that's a technical part of it, which Mark's probably more able to advise on than I am. But certainly from the times when I used to do it, it was always taken through the revaluation reserve first.
Okay, so if there's a surplus on the revaluation reserve on that particular asset, it will be taken to the revaluation reserve first. But then if it goes below its the initial amount it was capitalised at, then that would be taken to the income and expenditure account.
Mark's just jumped in, so I assume Mark will probably give me the right answer. Are you okay with that, Mark?
Yeah, just to confirm that is correct. So
okay.
we use up any previous revaluation gains first, so we reduce the revaluation reserve to 0, and then if there are any further losses, that goes through the income and expenditure account.
Okay, so if I might ask Bob then in his report if he can identify separately those amounts that will hit the income and expenditure account, then that would be really helpful. And I'm going to come back to this point later as well. Thank you.
Certainly we'll do that. Just to clarify, any gain or loss on disposal is recognised at the time of the disposal. Yeah.
Okay, thank you.
Okay, thank you. Any other members with questions? Any further questions? No, nobody's indicating. So I think that wraps up that topic. Thank you both very much, and thank all of you very much, including Mark. So next up, we've got item number 42, which is the corporate risk register. And I think, Andrew, is that for you to introduce?
It is, Chairman. Thank you, and good evening, members. So this is your regular update on the Council's corporate risk register. It's on page 19 in the pack. I'm just going to introduce the changes, but we've also got Matt Pope, Director of Adult Services, on the call tonight to talk about risk, particularly from an adult's perspective. And you'll see when I come onto it, we've got one new risk on the register today around health and social care reforms, which you'll have Matt in a second to talk in a bit more detail around that, no doubt. Just in terms of process then, since the last audit committee, we've had 2 meetings of what we call our risk champions group, which are a key part of the process. And this is representatives from each of the directorates working with myself as the risk facilitator to make sure that we've got that two-way communication between the corporate risk register that is fundamentally owned by the corporate leadership team, but then the individual directorates and their own directorate risk register, so that we've got that two-way process, as I said, in place, so we can escalate things both up to the corporate risk register, but move them back down to a directorate level. And what that risk champions group has been working on in particular in the couple of meetings that they've had since the last meeting with the audit committee is thinking about the presentation of the corporate risk register itself. It was one of the things that has been pointed out to us by our external auditors in the past. So some key presentational points, being clear what our current risk assessment is on each of our risks, being clear what the risk appetite for each risk is, or the target, if you like, and then being clear in terms of the mitigating actions that get us from that current risk assessment place down to the stated appetite level for each individual risk. And very keen to sort of hear any feedback sort of about the presentation and whether that helps. Hopefully it does, in terms of making it clearer in terms of where each of those risks are in terms of their individual profiles. What I did want to say, just by means of process, is at the next meeting of the committee in February, I'll be bringing the risk management policy and guidance back to the committee for you to consider, so we can have a more detailed discussion at that meeting around the process itself. Just before I hand over to Matt, just to talk about the risk register itself, it's summarised on page 23, which shows you the 15 corporate risks that are currently identified and where they sit on the matrix of impact and likelihood. And since the last meeting in September, as I've previously said, we've added one new risk, which is the health and social care reform. And we've removed two risks because we believe they've been mitigated, certainly from a corporate perspective, and they were the risk around IT infrastructure and the risk around telephony. Both of those have been subject to funding in this year's budget, and the projects have been put in place to mitigate the risks associated with both of those items. But that's all I wanted to say by means of introduction in terms of process and the risks themselves, but I'm happy to come back in a little while to pick up any detailed questions. But perhaps, Chairman, with your permission at this point, we could ask Matt to speak about adult social care.
That'd be great. Thank you.
Thank you, Andrew, and good evening, committee. I'm not quite sure how you do this, but there are 4 risks on the corporate risk register that relate to adults. Shall I just briefly kind of summarise where we are with those, and then take questions? Would that work, Jim?
Yeah, that would be good. And maybe as well, if possible, if you could touch upon your approach to risk in the department in general, about how you might, whether there's any emerging risks that sit on your own departmental risk register, and how those might bubble up onto the corporate risk register, and equally bubble back down to your individual ones. So just the risk management approach more generally would be really helpful. Thank you.
Yeah, no problem. I'll start with that. So in terms of our risk management approach, we have a departmental risk register which we discuss at least once a month and review regularly through our leadership team. We look at all the mitigations and the changing scores and how those risks change through that process. And then we take the ones that are sort of top of that list, goes to the corporate group, that working group that Andrew talks about. And then those are escalated onto the corporate risk register. That's a fairly regular dynamic process, and then discussed at our kind of corporate leadership team. So that's how it works. And I suppose a good example of that is the new risk on the corporate risk register, which is the risk number 13 around health and social care reform. And that's brand new and emerging risk, and is predominantly at this stage a financial risk to the council. So just to sort of explain that to the committee, the government has announced its intention to sort out the long-term future for adult social care and its funding, which is certainly well received within the department, because it's something that's needed to be fixed for a long time. As part of that, the levy was announced, which will generate about 12 billion a year. The issue and the risk to the council is in the detail of that, which we have so far. Most of that money seems to be going to the NHS, 10.2 of that 12, and only 1.8 to adult social care. And then when you look at some of the detail of the changes that have been announced, particularly around the care cap and funding thresholds, the gap between what Wokingham would probably get from that 1.8 million and the cost to the council, the additional cost to the council, seems extremely significant. We're looking at estimates from 20 million and higher around that. Now, it's still early days. There's a lot of detail to come out, but that's a significant risk and why it's on the risk register. One of the main reasons why that is such a large risk to Wokingham is that Wokingham has a lot of people who self-fund or privately fund their care. Under these changes, many more of those would likely to come to the council for assessment and to access local authority rates, and also to get a kind of meter running against that £86,000 cap. And just to give you a kind of indication of that, at the moment we support between 1,700 and 1,800 people on a regular basis. We think that would be closer to 5,000 once the full effect of these reforms take place. So you can see it's quite a significant difference in terms of number of people that we would need to support over time. So that's the main risk, number 13, and that's the new risk. In terms of mitigating actions, we're spending a lot of time talking to government and to MPs to make sure they understand some of these impacts so that we get to shape those reforms as they go forward. And we'll get some more detail, I believe, tomorrow in Parliament. I think the white paper for social care, the first draft will be announced. So we'll be waiting that and obviously poring over that when it comes out to see what some of those further effects might be. So that's the main new risk. The other risks on the risk register are risks 6, 7, and 14. Risks 6 and 14 are risks around our statutory functions. They're well mitigated. We've got lots of mitigations in place. I don't think there's a lot of residual risks there. But I think it's important that they're on the corporate risk register because obviously if anything went wrong in that area, that would have a high impact. But I think committee can be assured that we've got some well-established mitigations in that. That's not something that I'm worried about. But risk 7, which is about our care market, so most of the care that's directly provided to people is purchased in the independent, private, and voluntary sector, and that market is struggling from historic underfunding, obviously tied up with health and social care reform. That's an attempt to address that. But many providers are struggling, the effects of COVID, the effects of Brexit on their workforce, generally in the marketplace because of funding is low, people are paid quite low rates. That leads to vacancies in the care sector and underfunding. And there's been a lot of COVID grants which the government has released that we've given out to care providers, about 3.5 million. I think in the last financial year that they're relying on, and funding pressure on those providers is difficult. So capacity in the market is difficult to secure, and also some of those providers are finding it difficult to make ends meet. We've got lots of mitigations around that, but that's a national risk that we do quite well in Wokingham to support our providers. But it's a significant risk that's difficult to completely mitigate against until a long-term funding future of adult social care is sorted out. So I'm hoping that's a kind of useful. I hope I've given you a kind of understanding of our risk management approach and also a kind of brief summary of the risks that are relevant in the corporate risk register. More than happy to take questions if that's an easy way to go now.
Thank you. Imogen.
Hi there, Matt.
Hello.
Hello. I've got sort of two questions. One is being around the care workers. And obviously they have to now all be fully vaccinated against COVID. Have we lost any care workers or any significant number of care workers due to them not being vaccinated? Being number one.
So yeah, do you want me to take them one at a time, or?
We can do. The other thing is that I know that through Wokingham Town Council we fund a lot of charities who've been largely propping people up during the COVID lockdown and all this sort of thing. And what I'm worried about is as sort of we've moved out of that and we are moving out of that, but the long-term future is obviously getting it from the town council, funding from the town council isn't long-term sustainable. I'm just sort of wondering what's going to happen to all of the charities and organisations that are they going to continue and how they're going to do that? Because they're obviously picking up a lot of the problems with adult social care.
Okay, care workers and vaccines first then. Just to be clear, the mandatory vaccination applies to workers that go into care homes. Important to understand that the adult social care market is much wider than just care homes. Care because sometimes things are talked about in terms of hospital discharge and care homes, and people think that's adult social care. It's wider than that. But in terms of our care homes and losing care workers, there is an impact, but maybe not quite in the way that people think. So relatively small number of care workers in the borough that were unvaccinated and had to stop working in care homes in I would say in the region of 3-4% in total. And that's not affected really the viability of any care home or business in the borough. Our care providers have worked extremely hard to mitigate that. The issue that it gives is the culmination of pressures. If you've got underfunding, low paid staff, difficulty to recruit because of some issues around Brexit, as well as the pressures around that vaccination, what you get is capacity in that market contracting slightly or staying the same. Now, we need that market to grow because of demographics, more need, more people coming out of hospital. And that, therefore, then the risk is really struggling to have capacity in the market as opposed to that leading to businesses collapse. So that's more of the issue than perhaps what's in the media around some of that. In terms of charities, so I would say the absence of a long-term funding deal for adult social care makes it extremely difficult to commit to long-term funding for care providers or charities picking up non-statutory services. That's an issue. This kind of year-on-year kind of funding settlement and temporary grants makes it incredibly difficult for us to get a kind of sustainable financial solution, and that needs sorting out. And that does impact on charities. And I know they've suffered particularly through the pandemic because of loss of donation, and that's been a problem. That said, we have a voluntary sector strategy, and we're working with the voluntary sector, and we're actively putting in more money year on year to our voluntary sector. I think we announced about 600k additional funding for next year and going forward, and we're looking to solidify our adult social care spend in the charity sector through a reprocurement to give people security of tenure for their funding over the next three years and beyond. So I would say structurally we need to sort out that funding deal to councils and adult social care so we can do more there, but we're doing absolutely the most we can to support our charity and voluntary sector, because we know that they do fantastic work, they're great value, and also they do that work to keep people independent, to stop people going into crises, which therefore helps the pressure on the health and social care system. So they're fundamental. We must get as much of that funding upstream as we absolutely possibly can. So I hope that answers your question.
Thank you. Abdul.
Thank you, Chair. Hi, Matt. You just echoed 20 million, which is a serious amount of money. Is this within your department? You noted here 1, 5, 7, and 13.
So I didn't. What do you mean by 1, 5, 7, and 13?
Yeah, that's all in red. Is that all within your department?
Oh, what that 20 million estimate?
Yeah.
Yes, it is. Yes. Now, that comes with a heavy caveat because we haven't got a lot of details around the proposed reforms. But when we look at the scale and the magnitude, that gives you an order of magnitude, and that's just in my department, and that would be a net increased burden on the council once all these measures become fully in effect. It's a huge risk to the council. It wouldn't all happen overnight, but it just gives a sense of the enormity of that, or the potential enormity of that.
Thank you.
Okay, thank you. Shahid.
Thank you, Chair. Matt, and obviously one of the biggest impact during the pandemic has been on young and elderly people, mental issues, mental health issues, especially elderly people who've been living by themselves. That obviously is must increase the pressure on the social services as well, the care we provide. A question: have we had increased demand of mental health from the services we provide, and how much that is a risk to the council, and is that on the risk register?
I mean, most of the services for people's mental health in the borough are managed by health. So I suppose that's one statement to make. The role of the council is around people's social care needs around mental health, so daily living needs, as opposed to the treatment of the mental health. But also our role is around prevention, to try and keep people from needing mental health services. And we have seen an increase in need post pandemic, not just in mental health, actually across the whole of adult social care. But we have invested in some new services to kind of mitigate against that. We've got the Mind service that's in the borough, and that is working with GP surgeries to support people. And we have a year-on-year net increase in our spending to support people around social care with mental health. So it's not something I would say at the moment from a council point of view, for the bits the council responsible for, that I'd want to see on the corporate risk register. But demand is something that's very much on our directorate register, because we're watching that really carefully. We are seeing higher volumes of activity across the whole department. But at the moment, we are, we struggle like everyone to get staff in and things, but we have more staff than we've had before, and are mitigating that risk. I think the risk around mental health more sits with our health services, who are overwhelmed, and I know that means that acute beds for mental health are really short, in short supply, and that's an issue in a very similar way to the hospitals struggling through the winter, and I think that's where some of that risk is held. But that's obviously a health service risk rather than a social care and a council risk.
Marie.
I'm not quite up to date with this, but how long is the adult social care precept likely to last? And is there any talk about that being increased? Because I can imagine that residents may be fairly resistant to having more of an increase, although I appreciate completely why that might be necessary when they're already being charged 2.5% on their national insurance. So I'm just wondering whether you know what's going to happen with that.
Well, I suppose the first answer is, for me, is we have to sort out the long-term, as a society, in my view, we have to sort out the long-term funding for adult social care. How that funding is raised is a political question, which I'll keep out of. In terms of what I know, we know that the levy has been announced. How that levy is going to be used, I don't know. Hoping to find out a bit more tomorrow in the white paper. And in terms of the council's kind of government settlement, we won't learn about the detail of that until, I know Bob was on the call, but I think it's sort of mid-December. In that, I'm not sure quite what it's going to say about the precept, but I should imagine it will look to roll over the ability to use the precept as it does now. I don't think that will be a massive change in it, but I do think that there'll be like a 1 or 2% in there. And I think that's all I know about that. But again, we await for that to be announced so that we know for sure.
Thank
So
you.
I'm sorry, Maria. That's all I can say at the moment.
Thank you. Yeah, one more question from me, actually. Obviously, in recent times, there's been pretty big changes in the way our relationship with Optalis and Windsor and Maidenhead. So I wondered how that change in the relationship has impacted on our ability to manage these risks.
Sure. Yeah, I would say in a really positive way. We've worked really hard to get Optalis reshaped, new personnel in, clearer governance. I sit on the board with my lead member of Optalis, and we have a really well run company there, which we can use in whichever way we want to mitigate some of these risks in the market. Because we have our own direct care company, so we can take over bits of care where we need to. We can grow bits of care across the borough to fill gaps. So you're right to raise that. That's one of our key mitigation tools going forward.
Great, thank you very much. I can see no other members indicating, so I think you've exhausted all our questions. So Matt, thank you very much for your time.
Thank you. Thank you, committee.
And we can move on to item number 43, which is the Treasury Management Mid-Year Report.
Oh, we've only done Matt's bit of the risk register, none of the rest of it.
Oh, apologies. I was under the impression we were taking questions for everything all at once. But if you've got, let's row back.
We were just talking about Matt because he was there.
Yeah. Okay. That's good way of managing Matt's time. No, sorry. I didn't realise that. I know that Andrew is having slight connectivity issues. So, Andrew, are you with us at the moment?
I am with you, Chair.
Good. Okay then, Maria, fire away. I'll go on to Imogen afterwards.
Okay. I was going to ask a question about a very confusing item. Oh, by the way, I really like the new presentation. So where was it? It was the direct schools grant and something about taking things back. I really don't know how that works, and I'm wondering whether you could. Oh, I know. High needs block overspend. That was it. Risk 12.
Risk 12. Okay, just bear with me.
So due to the increased demands of this, then the overspend, it'll require repayment. So can you explain to me what that means?
Yeah, so this is I can explain it to you at a high level, at least, Maria. So this is again, it's a financial risk that there's a risk that we, as a council, we may be required to pay a substantial amount back to the Department for Education. So there's various sort of mitigations underway, and I think Carol Camus, when she came to the committee earlier on in the year, explained this. But I think, particularly as it's a financial risk, I think Bob's got his hand up and can probably explain it in more detail than I can.
Yeah, I think the thing that's confusing me is why an overspend means money going back rather than an underspend meaning money's going back. So if Bob can answer that would be great.
Yes, it's because the dedicated schools grant, especially the high needs block, is a ring fence element of the money that we get from DFE, Department for Education. Historically, this is not a political statement, just a statement, it has not been sufficient for the level of high needs education and special educational needs that we are providing as a council. Part of it is due to the complex demands of some of our young adults and pupils in the area and where we have to place them. But what we've been able to do under the government's guidance from DFE on accounting is that we can build up a deficit unusable reserve on our accounts. Now, currently, DFE guidance has been that this deficit should not be part of our accounts as a usable deficit or a deficit that we have to recognise that we may have a liability to repay. It sits as an unusable deficit in the accounts, but this risk is just highlighting the possibility that any change in the government policy may mean that the council would have to not repay, but actually make up that deficit shortfall. If DfE, first of all, say, A, it's not just sits as a deficit building up, B, they don't agree to fund that deficit and shortfall of funding, and C, they insist that we clear it down. So it's not a very high risk at this stage in terms of likelihood, but in terms of impact, it could be quite a significant amount of money. That to say, we do have sufficient balances within reserves if we are forced to clear that deficit down. But this would be the same for many other local authorities, and other authorities in a less well-off position than Wokingham Borough Council would certainly suffer huge budgetary pressures if we were, or central government had mandated that this deficit needs to be cleared. For example, many London boroughs are running about 20 to 30 million pounds of DSG high needs deficit. Ours is not running at that level at all.
Good, because that's my next question. What is it running at?
I don't have the figure to hand. I believe it's something like 4 million or 4.6 million. Again, if needs be, I will get our team to just send a note round saying what the current position is and what the forecast position is for the end of the year. It is reported, I believe, in our quarterly monitoring reports that are reported as public documents to executive. I think, is that right, Mark?
Yeah, it's included in our quarterly reports.
So it is available and in the public domain if you wish to look at them.
Thank you.
I'll go to Imogen first and get any.
Hello, Bob. I'm not sure if it kind of got covered, but the high needs block overspend, obviously with the number point 12, the high needs block overspend, we've got the Winnish Farm School. I'm sort of wondering what the risk is if we don't get the money for that school. You know, are we going to have to get a loan? Are we what's or you know, how much is this going to cost? Because obviously the upcoming children have to go to schools far and wide because we don't have enough provision here. It's going to be quite expensive. So I'm just sort of wondering what's going on with that.
I don't know. It's probably a question better posed to Children's Services rather than us. Again, we can find out, but it's certainly not one I have current knowledge of where we are, other than we believe it is funded. Well, I believe it is indicated that it is funded, but if it fails to come through, then it's a decision for the Children's Services Department whether they wish to proceed with it or find alternative methods of provision. I can't answer any more than that right now.
But isn't that put it to a higher risk than what it is on this risk register?
Chairman, if I could suggest taking that action away, and we'll pick that up with Children's Services and make sure that it's being dealt with appropriately at Children's Services level, or if indeed it does need to be escalated to the corporate risk register. So we'll include that in our next update.
Thank you.
Just to clarify on point 12, the risk is the high needs block overspend, Winnish Farm School, and the other ones are actually part of the plan to how we're going to reduce that deficit over a number of years. So again, if it doesn't materialise, then in terms of reducing the deficit, it won't. That's the point.
I realise it's talking about, but obviously it's going to be significantly affected if we can't build this school. So, which is what my concern is on the risk register. It probably needs to be a bit bumped up. I could be wrong. Okay. My second question is on point 1, the budget resilience and finance resilience. It is still at quite a high level, and I'm just sort of wondering why, since we last looked at this, it hasn't really changed. That's probably, I don't know who that's for.
Do you want me to start and then please chip in, Bob? But I would say probably one of the key reasons for it still being very high is because of the uncertainty around the 3-year settlement that the government is due to announce, as we've already said this evening, in 2-3 weeks' time, this side of Christmas. But Bob, I don't know whether you'd want to add to that.
I think that's the key reason why it stays on the risk register, and it's there is so much uncertainty around the level of local government funding, particularly in terms of the levelling up agenda as well coming through, and what it means for councils such as Wokingham, situated in the southeast. And again, it's not just that, there's other functions that are occurring around all the time. I think if we do get a 3-year settlement, it would give us the opportunity to start doing some serious longer term budget planning around that settlement, and that may allow us to drop the risk likelihood on the risk. I think the actual impact of the risk still remains fairly high, because it is obviously a key part of the council's exposure to any risks and government legislation changes around funding.
Okay, thank you.
Thank you. Ian.
If I could switch to risk number 9, climate emergency. It talks about the complexity of the behaviour change required as being fundamental to the high level of risk that's attached to that. One of the major behaviour changes is to persuade people to give up the fossil fuel vehicle and switch to walking, cycling and public transport. And yet we seem to be spending a great deal of money attempting to reduce congestion. In other words, to make it easier for fossil fuel transport, which has been proven elsewhere just to simply increase the amount of car use. Why is there no, instead of that, why are we actually spending more money and taking more actions to change the behavior towards walking, cycling, using public transport, and investing in those means of people getting to places instead of making it easier to drive cars around?
I would say, from an officer's perspective, I think that's a fair challenge. I think just going back to my point about sort of presentation of the risk register, one of the things that we've tried to do this time, and I don't think we've quite got it right yet, is to be clearer about what the actual risk is. So you can see there, Councillor Shenton, that we've described that particular risk in one way. I do take your point that this is multifaceted, and possibly we've not captured that appropriately at this stage. Very happy to take that away and reconsider whether we've really crystallised the risk and we have got the appropriate risk mitigation actions in place. So again, another action for me to take back.
Thank you. Shahid.
Thank you, Chair. It's again coming back to the risk 12, high needs block overspend. This particular risk has been going on for some time now, several years, and I assume the year on year, the risk is getting sort of, on a bigger scale. And therefore, as a result, it must be, assume it's being reflected on the risk register as well, the risk going at a higher level. I can't see the history, but assume that is what's been happening. But also mitigating action is discussion with the Education and Skills Funding Agency. Where are we with that? And any resolution in sight, or are we still discussion and we're not sure, where things are on that?
Well, I would say on that certainly if we look back historically, that this risk has grown for the council over recent years, and as we said previously, that's been reported through the regular public reports to executive. And as I say, I think if you looked at the risk register reports that this committee has considered, you would see that trend as well. I think not to repeat what Bob said earlier, but this is a bit of a watching brief at the moment. I think all local authorities are in the same position in terms of this risk, although the impact for it for other councils is higher than it is for this council, as Bob's explained previously. But it is something of a watching brief. But I can see Bob's got his hand up to add to that.
Yes, just to say we are in dialogue and discussion with the ESFA and the DfE. They have requested that all local authorities that are running a high needs block deficit have an action plan to first of all slow down the supertanker, then stop it, and then turn it round. I believe we're at the point of stopping it, and we're starting the process of trying to turn it round. So it is, as Andrew says, a watching brief for what we can do, but part of our mitigations and action plans is to certainly slow the increase in the deficit, and that certainly has been happening. It is, though, a very difficult area depending on the level of funding that we are receiving coming through, and as part of the conversations with ESFA and also with DfE, and by use of our various lobby groups, the LGA, the Society of Unity Treasurers, we are making representations to the government to see if we can get more funding for schools, especially high needs and special educational needs.
Thank you, Maria.
I'd just like to return to risk one, and it's just an example of why I'm uncomfortable with the whole risk register. I'm very happy with the identification of the risks and some of the controls that are said. But for example, for risk one, the mitigations are lobbying the government, overview and scrutiny, approval of a balanced budget, and actioning internal and external audit. These were also present in June 2021. 3 of them were there as mitigations, and I think 1 as a control in November 2020. And the same in June 2020. So what I'm uncomfortable about is the fact that we say these are the risks, and there are a lot of really high ones, and the targets are great. I can see them moving down. See, the appetite for risk is much lower, and I think that's why I'm concerned. The appetite for all of these, for most of these risks, is much lower, but they're just not moving. And I'm just not happy with this risk register and its descriptions of controls and mitigations, because it doesn't seem to be getting us anywhere. And that is just a general comment about it. I guess, I don't know, maybe Andrew can comment, but we just don't seem to be going anywhere in terms of reducing risks. And that worries me.
If I could just comment on that, Chair. So what I would say is that with the presentation that we've got now, I think it's much clearer that you can see the target that is being aimed at. That was perhaps not as clear as it was presentationally in the past. I think if you look across the 15 risks, some of them are on target against the appetite that we've got. I think there is a general aspiration or objective to reduce the impact or likelihood of some of these. I think that part of the role, part of my role, part of officer's role is to do exactly that challenge that Maria's just given us in terms of have we got the right mitigating actions to get us to the level that we require. I think it's also part of the Audit Committee's remit as well to not just sort of challenge have we got the right mitigations, but are there any suggestions that this committee could provide in terms of things that would help us get quicker to the desired risk levels that we've got. But hopefully, at least presentationally, you've got a clearer view tonight as to what we're aspiring across each of those 15 risks.
Thank you. Angus.
Thank you, Chairman. I do like the presentation on page 23 where we've got a sort of an overview picture of which we then refer to. And I looked at reference number 7. It says supplier failure. My automatic sort of thought was, post COVID, we've got all sorts of supply problems of goods and other services. That's what it is. Then when I look at the actual description on page 31, it's all about adult social care, and the needs in care in the care sector. So perhaps that supplier failure word should be perhaps written slightly differently.
Yeah, I think that's a really fair observation. That as you heard from Matt Pope earlier, that the particular concerns are around market failure in an adult social care context. I think there is a general concern that is perhaps not yet at the corporate risk register level about supplier failure across other key contracts that the council may have, but they're being managed at a directorate level. But I think it's perhaps that the point that Councillor Ross makes is just indicative of we're going through this transition process at the moment to get a better presentation, clearer presentation, but really make sure that we're sort of crystallising the risks properly and there's a clear read across from the summaries to the details.
Abdul.
Thank you, Chair. My question to Bob. Are we overlapping number 12 risk and number 5?
Well, perhaps I could take that. I know you asked Bob, but the answer from a process point of view is, yeah, there is quite a lot of interdependency or overlap between risk 5 and risk 12. But again, Bob, would you like to add to that?
Yes, other than obviously they are two very high service area risks for the children's services education system. I suppose if we treat 5 and bring in more provision of local educational needs, it will certainly help reduce 12 as well. A lot of our cost on the high needs block is out of borough placements, both in terms of the actual cost of the placement and the cost of providing transportation to the young adults who require the out of borough placements. So yes, I think in part of the way of dealing with 5 will also help mitigate some of 12. 12 is more of a risk that we have to pay money or have to make up the deficit ourselves. 5 is actually about the provision of service for our local residents.
Okay, thank you. Maybe this is not relevant, but where are we with Reading Borough Council? They are supposed to be our partners with the New Wenish School. Again,
I don't have the answer to that unless Andrew does, but we can probably get the service to provide some report.
Yeah, I don't have the answer to hand, but I'll take that action away, as I said earlier, and I'll come back to the committee on that point.
Thank you.
Thank you. Any other questions? Don't want to skip on again by accident. I can't see anybody indicating. We need to take a vote on this item as well. So the recommendation here is to note the report, essentially, to consider and note the risks and mitigating actions, the corporate risks as detailed in the attached corporate risk register. So I can see a show of hands for noting the report. Okay. Any votes against? And any abstentions? Okay, thank you very much.
Are you casting your vote for?
Yeah, I did.
Right.
I had my hand up, so that's carried. Thank you. So now we're on to item number 43, which is the Treasury Management Report. Bob, would you like to lead us off on that one, please?
Yes. Good evening again, everyone. This is the mid-year Treasury Management Report. It is the second of the 3 Treasury reports that we take through this committee and onto Council. The other ones being the annual Treasury Management Strategy, and the other one, and then the final report being the end of year outturn report on the Treasury position and where we have turned out through the year. The mid-year report is as at the 30th of September, so the end of the second quarter financially, and basically gives a summary of where we are with our prudential indicators and also where we think we were going to outturn at the end of the financial year in terms of our main Treasury benchmarks, being our level of debt, our level of borrowing, and also our return on our investments that the council has made. It is in the format of the report that we introduced last year, although we've further enhanced it, we believe, by adding in clearer the prudential indicators following observations by this committee previously. So we made the prudential indicators that we are reporting on quite clear and in the reports. And the report no longer goes through executive, it goes directly from this committee to a council, hence the recommendation to recommend to council and to note the prudential indicators. Rather than go through the individual details in the report, I'm happy to take questions, or probably more likely delegate the questions to Mark, who's ready and waiting. But yes, and I hand it over to yourselves.
Okay, thank you. Members, any questions on the report? Abdul.
Thank you, Chairman. Page 43, if you just give us more detail about the two less internal funded borrowing, 1.9 million. If you could just give us some example of how this come about. Page 43, I'm referring to.
Oh, the 190 million in there.
Yeah, 15 million, yeah.
Yes, if you can recall the outturn report we produced to this committee previously this year, we had the point there of over borrowing, i.e. our actual borrowing exceeded our capital financing requirement. Following that, and this was done for various reasons, particularly around the availability of money in the money markets and the extremely low rates of borrowing available. What we've done and what we're doing throughout the whole financial year is trying to reverse that level of over borrowing to bring us a point where we're potentially 1/3 internally borrowing funded, 2/3 external borrowing funded. And all we're doing here is reversing that to the position at year end of £190 million of internal funded borrowing. This has come around by, first of all, repaying elements of debt when we've had receipts available to repay it, and also reducing our level of internal investments or investments we've lending out. And that balance, as you can see, is coming down as well. So our cash investment balances have come, or will come down, from 296 currently to 89 million. And that's where we're paying that money off our debt and therefore take on a higher level of internal borrowing.
Okay, thank you. Another question, just for clarification. Page 42, I don't really understand about the HRA, housing revenue, from 16.52 to 14.96, the differential. Page 42, I'm referring to HRA.
Yes, yes, yes. All that is just the change of our borrowing costs, financing costs against the actual level of our revenue stream in the HRA. So obviously, a reduction in the ratio is a good news story, in that we are now having less borrowing costs as a percentage of our income that we take in the HRA.
Thank you.
Thank you. Maria.
Yeah, I'm just going to return to what I mentioned before about revaluation losses or losses on sale. So as we know, the presentation of the Treasury Management Reports has changed, and now we have in it things like the income from assets we're investing in. And the report states that that income is used to fund services. Well, it'll only fund services to the extent that there are no losses taken to the income and expenditure account on assets that we've invested in. And there were some last year. I think there's 1.6 million, wasn't there, on Carnival Pool car park, something like that. I'm sure Bob can remind me what that was. And there were some others as well. So I think while it may be true that we've got some income to take to provide services, it's not quite the whole picture, because I think we should be deducting from that any amounts that we've had to take through the income and expenditure account for any losses on revaluation of assets that have been funded by that borrowing. I'm thinking in particular coming up things like the the houses on Denmark Street, which don't seem to be selling, and some of the assets that we've got up for rental that we discussed with Helen, I think, in the previous meeting, that if they're not being rented, then their market value is likely to be lower than it would otherwise be. So I'd like to know how much last year and this year we are likely to have going through the income and expenditure account as to reduce income available to spend on residents.
I think potentially we're confusing two reports here between the Treasury report. The Treasury report is basing itself on the availability and returns we are taking from our investment strategies the council runs as part of its Treasury processes. The valuations and the assets and the I&E account are part of our annual statement of accounts that run through there. I think where we say that this benefit or this money that's reinvested in services is not to say that we are taking this money as a profit for our shareholders. We don't have shareholders in the council. It is not going into a big bonus pot for officers. What it means is that any money we generate from our investment activities over and above our cost of financing those investment activities, which is generally the cost of the borrowing and the cost of repayment of any borrowing, becomes available for us to use to provide services to our residents. Now, obviously, without going into political discussion around it, the council gets capped by the government on the amount it can raise its council tax by. Currently, that cap is running at just under 2%. The rate of inflation that the council is working with, we know in the country, is anything between 3% and 4%. That means that actually just the council tax raise the council makes means the council is not even standing still. It's going backwards in real terms of its revenues. So anything the council can do from its investment activities that allows us to continue to deliver service to residents is why we do these activities. The revaluation and the Carnival Pool are actually operational land and buildings, not investment properties. We will do obviously any impairments around our properties, but we have basically set aside a revenue provision each year that we have agreed through legal counsel advice and have run past EY as a relatively prudent minimum revenue provision for our investment properties, and that's currently running at 10% over 15 years, which I believe is a prudent issue. If we do see an extraordinary reduction in the value of our properties, we would have to make a voluntary revenue provision through our accounts to make sure we are covering any devaluation in our properties. Now, this is currently the process we follow. There is a government consultation out around the level of minimum revenue provision, which we need to obviously take into account when we set our provision going forward.
Yeah, but I still think that the benefit of 36.62 that is being predicted is like a benefit, if you like, to shareholders, because you're saying that it makes up for council tax that we wouldn't otherwise be able to raise. My argument is that if you've got losses that are going through an income and expenditure account, then those losses are going to reduce the benefit to council taxpayers. And therefore, this report, if it's going to include all of these other things, which I don't really agree with anyway, I think it should be just a straightforward Treasury management report. If it's going to include all of those things like contributions towards financing costs from the following areas, then you've also got to take into account, if you're going to talk about providing services to residents, you have to take into account those things that might reduce cash flow for services to residents or reduce the income available for services to residents. And that would include any amounts you took to the income and expenditure account on things like housing, local economy and regeneration, or commercial investments. Town centre regeneration isn't in there yet, I see. So I don't think it gives the full picture, is my argument. We can agree to disagree, Bob, but that is my
That's
view.
fine. I'll just point out that we do make a minimum revenue provision, which is included in our financing costs. So to then take another impairment cost through, we're actually double counting the hit to our residents, because we're making that minimum revenue provision. We're providing already for any downward valuation in the value of our assets. And as I say, only if it becomes extraordinary will we have to make a single further downward valuation in those assets, which would then have to bring into the accounts on these accounts here. As it stands right now, we make a prudent provision that we've agreed.
I think, wasn't the minimum revenue provision supposed to be for paying off the loans? It's a financing cost. It is. So it's not an impairment amount.
No,
it's for paying off loans. It's for paying off borrowings, isn't it?
It is for paying off borrowing in one way. There are 5 different measures that we can set for minimum revenue provision, and we have a policy in our Treasury management strategy that allows us to make a variety of different provisions depending on the type and nature of the asset. Currently, in this position here, because these are investment properties and not operational land and buildings, they are potentially available for sale if we ever needed to. So as it stands, it would be almost wrong to make a deduction and a charge to the local taxpayer to pay off the borrowing for an asset that we could already pay off when we liquidate that asset and sell it on the market. And the whole idea of the investment portfolio is it is available for sale if need be as a liquid asset for disposal. So in reality, to make a second provision that charges the taxpayer for the whole amount is overcharging them and actually impacting on our revenue about balances for our taxpayers. So the decision we've taken prudently, in my view, is to hold the assets available to repay the principal of the loan. We take the interest and financing charges on the loan through the income we receive, and we also make an additional provision for a potential 10% loss in the value of that asset over the 15-year life we're using for it. So I think to make any further provision would be over providing unless we have demonstrable evidence of an impairment or a downward valuation that is going to remain permanent.
Thank you.
Thank you. Imogen.
My question is somewhat simple. It's basically, obviously, we've re-profiled the capital expenditure for forthcoming years. It doesn't say how that has been achieved. You know, what is not being done and what services are not being implemented, and where does it come from, basically?
The reprofiling of the capital programme is part of our capital monitoring. So when we monitor our capital expenditure programme for the year, and also when we set our capital budgets going forward for the next few years on it, that the amount that we spend on capital impacts on the amount we need to borrow as a council, which is where it comes through into this Treasury report. But the details of around what capital programmes are being reprofiled are actually in the capital monitoring reports that go to executive at the end of each quarter.
So we're not able to see what has been changed at this point in time, is what you're telling me.
Not in this report, no, it would be in the available.
So I'm looking at this and I'm thinking, well, how can we agree to this if we don't know what services and things or what projects are going to be impacted by what is in here?
I believe the Q2 capital monitoring report has already been to executive and available for the committee to view. We can't reproduce the full capital report in the Treasury report because the nature of it is a Treasury report, and we've been trying over the last few years to simplify these reports and bring down the size of them. We did at one point almost produce the Encyclopedia Britannica on these Treasury reports. Which
I just want to know what services have been impacted by reprofiling. That's what
that would be in the capital report that went to executive. It was at the end of September was the report date, so I assume it went to the last executive or the executive prior to this one, maybe the end of Is it October, Mark, or has it gone to the November executive?
End of October, Q2.
Okay.
Okay, thank you. Any other members got any questions? Abdul.
Thank you, Chair. How likely is 36.62 or 36.62 per band D equivalent likely to change?
It will possibly change depending on any change and fluctuation with the Bank of England base rate. Obviously, this report was written or drafted initially as at the end of September. We have seen in the markets pricing in a Bank of England base rate uplift. Now, of course, that will have two effects. One, it will increase the cost of any new borrowing we do. And again, we're trying to limit the amount of new borrowing we do. But it also will increase the rate of return we get on any money we lend out to people. So how much is likely to change? I'm fairly certain it will probably change when we get to the final outturn report. Which way it will change, I'm afraid I can't say, other than we know there might be differences because of changes in the base rate and the availability of funding and suitable counterparties, depending on what happens there. Mark's got a hand up. Thanks.
I think just to add that we're not forecasting to take any more external borrowing until March time. So any impact will be only 1 month's worth in terms of the 8.5 million that we're reporting as our total cost for interest and debt repayment. So we're pretty confident that number will remain in that ballpark figure.
Thank you for the assurance.
Thank you. Final call for any other questions. Not see anybody indicating, so we can go to the recommendations. So we've got 3 recommendations there you can see on page 41. Can I have those in favour to show, please? Vote in favour? Yep. Okay. Any votes against? Okay, and then any abstentions? No. Okay, so thank you very much. That's carried. And that takes us to agenda item number 44, which is the procurement of external audit. And I think this is back to Andrew. He's still with us, still connected.
I'm still, holding on here. My broadband's hanging out. So, thank you, Chairman. So this is on page 47 of your pack. So the report sets out proposals for appointing the external auditor to the council for the accounts for the 5-year period starting 2023-24. The Audit Committee is asked to consider and then recommend on to council at the council meeting on the 20th of January its preferred approach across one of 3 options. So the 3 options are set out in the recommendation itself, but the officer recommendation is to strongly recommend option 1, which is to use the sector-led body, the Public Sector Audit Appointments Company, by indicating an option to opt in to that process. Just to give you a little bit of context, when the council agreed its latest appointment of external auditors back in 2018, it used the same process. I think I'm right in saying that somewhere in the region of 90 to 95% of local authorities use the sector-led body, the PSAA, for the appointment process. The intelligence that I've got, certainly in Berkshire this time, is that all the Berkshire authorities at the moment are intending to use option 1, the PSAA process. In terms of the benefits of option 1, we believe that there's very much financial benefits through that bulk buying approach, and also quality benefits in terms of the leverage that the PSA can put over the market. So I think it's a strong case in favour of option 1, but it's for the Audit Committee to consider and then to recommend on to the January Council the preferred approach. I'll pause there, Chairman, and take questions.
Thank you. Do any members have questions? Ian?
Just a very simple one, point of clarification more than anything else. Is there any requirement to rotate auditors or audit partners?
The appointment process would be undertaken by the PSAA, but I can see Helen's hand is up there. So perhaps Helen would like to just comment on that particular comment around rotation of auditors.
Thanks, Andrew. So to answer the question, there is a requirement by PSAA that engagement leads, so the equivalent of me, should be in place for no more than, and it's a bit complicated, 5 years plus a 2-year extension. So a normal appointment would be for 5 years. It can be extended with PSAA agreement and council agreement for a further 2 years, and that is actually the position for Wokingham. In terms of firm rotation, we're not subject to quite the same rules as our corporate colleagues and the rules that apply to listed entities, but PSAA does try to adhere to some of that, and so I'm sure that they will be looking at rotation as part of their contract setting process when it gets to that. So if a firm has been appointed for a long period of time to any one organisation, they will look to do that, but it is complicated. So it's not quite the same as in the corporate world, but they do look at both firm appointment and individual partner appointment.
Right, thank you.
Thank you. Any other questions from members on this one? No. Okay. So I think, I mean, certainly for me, I think option 1 is clearly the way we should be going. But I guess we can put that to a vote here. So option 1 being the PSAA-led approach, to recommend that to council. So can we have votes in favour of that, please? Okay, thank you. That's unanimous. Right, so that was good. And now we are on to number 45, which is the internal audit report, a work programme update. So is that Catherine to lead on that one, or is that Andrew to kick us off? See, Catherine, you've...
Yes.
Yeah, cool. Thank you. Go ahead.
Thank you, Chair, and good evening, everyone. The report I'm presenting is item 45 in the agenda pack, which is on pages 53 to 64. And the main purpose of the report is to update members on progress in achieving the 21-22 Internal Audit and Investigation Work Programme. I did previously report to your September meeting with progress to the end of August, and this report provides an update with a further 2 months of audit activity to the end of October. So key points to highlight from the report are that during the period since I last reported, we've been undertaking a number of audits of key corporate risks. Specifically, recently we've completed a piece of work on the Council's corporate governance arrangements. And this, I think, is an audit that we can use to demonstrate to members our new added value approach to internal audit work and the provision of a different audit product. For the actual audit, internal audit worked with the statutory officers, and we developed a toolkit for the ongoing monitoring of the Council's corporate governance arrangements against its local code of corporate governance. The aim was to assist in further embedding corporate governance across the Council, and we'll also use this work to inform the preparation of the annual governance statement and the associated action plan, which will come to Audit Committee in due course. So through using this toolkit, statutory officers can have assurances about the Council's corporate governance arrangements, which can be regularly monitored throughout the year, rather than this being a one-off year-end exercise. The work has also helped to inform the peer review, which took place in November, whereby internal audit acted as a critical friend in terms of the Council's initial self-assessment of the Council's corporate governance arrangements ahead of the peer review. So I think this is a piece of internal audit work it's new and valuable to the Council. Another key corporate risk area that we've commenced some work on is in terms of climate emergency. And again, this is a new approach that we're having to our audit. we're undertaking a joint piece of work under a co-sourced arrangement through an audit framework, and this will help to enhance the audit product in areas where we need more technical expertise, climate emergency being one of those areas. So since I last reported to Audit Committee, I've scoped with PricewaterhouseCoopers, who we're procuring through the audit framework, and we've agreed an audit, and that work will commence in December. Other key corporate risks where we're commencing work is in the area of equalities and diversity. We're just scoping 2 pieces of work in that area at the moment. And we've previously mentioned the PPP audit, so I've had initial discussions with the interim Director of Place and Growth, and we've agreed a high-level review in that area planned in early Q4. So in addition to the specific key corporate risk work, we've undertaken and we're commencing work on key financial systems. We've commenced a number of those audits, which we usually plan for Q3 and 4 of the financial year. So we're on schedule with those. And additionally, we've certified a number of grant claims. So if you turn to Appendix A, which is on pages 57 to 63, this shows the status of the audits from the 21-22 audit plan. And you'll be aware that when we undertake our audit work, we assign a category of audit opinion, with 1 being the highest category of opinion and 4 being the lowest. And for those audits that have been completed during the year to date, and where an audit opinion is appropriate, none have fallen into the categories 3 or 4 of audit opinion. So I hope this helps to give members an overview of the key aspects of the work in the 2 months since I last reported our audit activity to the end of August. And this report is coming to members to note the progress against the audit plan for this financial year. And I'm happy to answer any questions.
Thank you. Any questions, members? Maria?
Yeah. Thank you. Thank you very much, Catherine, for that. I'm just looking at, so all of these audits have to be done this year. Is that right?
That's correct, yeah.
I'm just looking at how many are still outstanding. Are they all going to be achieved? Because it looks an awful lot of work, particularly as the SEND one has been delayed. That sounds as though it might be a lot of work. What's your opinion about whether it's all going to be completed by March 2022?
Well, that's what we're aiming to achieve. Obviously, there may be other factors that might prohibit that from happening. For example, as you say, the SEND review was planned originally for Q1. So if there's anything else that impacts on that may come to a deferral. But if there are any deferrals, those will get reported back to the Audit Committee. But our plan is to aim to achieve this by the year end.
Okay, thank you.
I'll just also say, Councillor, that usually there is also some carry forward of audits, so audits will be in progress. We don't come to a position where absolutely everything is completely completed by year end. It's natural that there will be some overflow into the next financial year.
Okay, thank you. Just a couple more comments. The climate emergency, it says that was requested by overview and scrutiny. Is this the same one that was actually requested by audit? Is that just an error?
It's the same one.
It's the same one. It was requested by this committee, I think.
Right. I thought originally it came to overview and scrutiny, and then it came to this committee. But
no, I think it was former councillor Rachel Burgess asked for that. Oh, Andrew looks like he wants to clarify.
I know this committee has asked for it, and you particularly, picked it up through the scrutiny of the corporate risk register. But overview and scrutiny did look at climate emergency as well, and there were a series of recommendations there that officers responded to, and one of them was around a carbon audit, and we'll be picking up through the internal audit the recommendations made through the scrutiny process as well.
Okay, so it's the climate emergency action plan, I think, is what former councillor, it's not former councillor, she was on this committee, yes. Councillor Burgess wanted. So that's still going ahead, plus picking up some things from overview and scrutiny.
Yes.
Yeah. Sorry, Rachel, if you're watching this, I haven't sacked you or anything. And the other thing is just a small thing. I think the key for the 1, 2, 3 and 4 of the audit opinion, I can't find it anywhere in the document. And I know you did put it in last time. So I'm just wondering whether, is it in there somewhere and I've just missed it?
No, I think it's fallen off the end. So I can do that for next time. Apologies for that.
Okay, thank you very much. That's fine. Thanks.
Okay, thank you. Any other members got some questions on this? No. Imogen, yeah, you got a question?
Sort of. I know one of the problems that we have is particularly when calls come in through the customer services team, they seem to sometimes get lost when on their way to the highways maintenance or the housing systems, because there's different, obviously, IT systems gluing them together. I'm just wondering if there's anything, I don't know, I think it's an audit thing, to track that and monitor that, or likely to be.
We haven't got anything specifically in the plan for this year, but happy to pick up any concerns for any future work that we could incorporate that into. Okay,
it's just that sort of more recently, because I know it comes into the CRM system and sometimes the calls get lost because HIMS is obviously the highways maintenance one. There's a housing system, because obviously the customer services people then have to transfer them into other IT systems that they have. And from what I understand is that some calls get lost en route.
Okay, I'll take that away. Thank you, Councillor.
Thank you.
Thank you. Any other questions or comments? No, it doesn't look like it. Thank you very much for the report. We'll take a vote now to note the report. Can I see a show of hands in favour of noting the report? Okay, thank you very much. And now we are on to item 46, which is the forward programme. Through to this, so it's on page 65. You got any comments or questions on the forward programme, which is only one meeting, I think, on the 2nd of February? Anybody got any points to raise on that? Helen, you're indicating. Would you like to make a comment?
Yes, thanks, Chairman, and my apologies to Madeline because I should have looked at this and let her know earlier. But in terms of the EY items, the 2021 annual audit letter, that's the name of the report will be Auditors Annual Report, which I appreciate is only a subtle difference, but it includes the VFM commentary. Just for the committee's benefit, my intention is that if we are able to, we would bring you a draft, but it can't be finalised until we've issued the opinion. So there's a bit of chicken and egg. You know, we need to get the opinion signed and then we can issue the auditor's annual report from that. So that item 4 may need to fall into the following committee, whenever that might be. I will know better in February. But it's more the change of name. And I suspect the outline audit plan will also need to move into the next meeting, which might make things a bit easier as that's quite a heavy agenda.
Yeah, it is. Thank you for that. I'm sure we'll make those changes. Anybody else got any final comments? No, doesn't look like it. So I think that's the end of the agenda. And thank you. Catherine, you're indicating.
Hello, yes, thank you, Chair. Just to mention as well, the 2022-23 internal audit plan and strategy and internal audit charter will come to the February meeting. That's not actually listed at the moment.
Okay, thank you very much. Yeah, hopefully we've got the time to get through all the it looks like quite a heavy meeting. You might need to think about that. Maria.
Yeah, I'd just like to say thank you to Bob for coming to our meetings and explaining everything to us and presenting all the reports and stuff like that. Thank you very much, Bob.
May I respond, Chair?
Yeah, no. Yeah,
just like say,
absolutely. No, thank you, Bob. I know, yeah, it's your last one of these.
Yeah.
Before we move on to pastures news, so I'd say probably, you know, on behalf of all the committee, thank you very much for your contributions to this committee, and it's been great to work with you. And do you want to respond?
Yes, thank you very much, Chair and councillors. I've enjoyed coming to these committees. It provides a challenge that I enjoy and relish, and thank you for your time, and I believe a lot of valid questions that keep me on my mettle. So thank you very much.
Great, thank you very much. Well, hopefully our paths cross again at some point in the future. Thank you very much.
Thank you.
Thank you, members. That wraps up today's Audit Committee meeting. Thank you very much. Good night.